Rich, good to see you. Obviously, today we have a little bit of relief, a relatively calm rally, very different in tone from the volatile tape we've had in place. And, you know, some of the things that you've been kind of looking for quite some time have absolutely been reflected in this market this year, right? You have defensive stocks vastly outperforming cyclical ones, energies beating tech by, 75 percentage points this year. I guess the question is, can that continue? Or do you think that the market has kind of reached a spot where it's taken account of the things you were looking for?
Well, Mike, thank you for that. There are things that I've gotten wrong too, but thank you for pointing out all the things that we've gotten right. But I think that what you saw a little bit today with tech rebounding and things like that is kind of a hope. I don't like to use that word, but kind of a hope that we go back to the environment that we were in before the pandemic, right? There's a lot of investors who are really hoping that this is just a bad dream, that inflation's temporary, that we'll wake up tomorrow and somehow it'll be 2018 all over again. And you saw a little bit of that today in the market action. Personally, I don't think the probability of that happening is even reasonable to even consider. I think the economy has changed meaningfully and semi-permanently, and so I think you're probably going to see late cycle and defensive stocks continue to outperform here.
Can late cycle stocks outperform for an extended period of time without the cycle ending? That seems to be one of the other questions here. I mean, are we just counting down the ticks to ultimately a recession? And what does that mean for the market?
Well, on the first part, in terms of recession, I think our view is the recession is farther out in the future than most people think. You know, when one considers that the real Fed funds rate minus inflation, is still almost historically negative. But yet every recession in the last 50 years has been preceded by a positive real Fed funds rate. So we're historically negative. It's usually preceded by a positive real Fed funds rate. It seems to us that the Fed is kind of hunting elephants with a pea shooter here, and therefore the recession is probably farther out in the future. But that being said, let's say we're wrong on that and recession's closer in than we think. One has to remember that inflation is a lagging indicator. And so what generally happens is late cycle stocks hang on into the early stages of the recession, and then defensives really kick in. So, you know, our portfolios are really constructed with an eye towards that late cycle with, over the past several months, increasing weight in defensives, as you mentioned before.
Well, let's talk about, that elephant that the Fed is hunting. Inflation, you suggest it's going to be around a while, more structurally, not going to ease back toward, the mild levels of 2018. But how high, for how long? What does it, I guess, mean for overall stock market multiples, too?
Right. Mike, I think it's very exciting to talk about 8 or 7 or 6% inflation. But I don't think as an investor that's really the way you want to think about it. You want to think about secular inflation, right? What's inflation going to be over the next year, 3 years, 5 years, or even 10 years if you really are a long-term investor? There aren't many out there anymore, but if you're really a long-term investor, that's what you want to think about. Long-term inflation in the United States is about 2.5%. And most consensus forecasts right now are between 2 and 3%. So what you have to do is you have to make a bet, will inflation be higher secularly than 3%? We think it will be because of these structural changes that are going on right now. But most portfolios are still constructed for the environment we were in, which is basically sub 2% inflation. And that's where we think the opportunity lies, is that people are waiting to go back to that sub 2% environment.